Hello, I am Aiden Magaro.
And I'm Graham Zander.
And today we're going to discuss the three major events that change our nation's banking landscape forever. This is our second episode of the series, and we will be discussing the 2008 financial crisis. We will start by providing some background information. In 2003, the interest rates were a very low 1%. Because of this reason, many people felt like taking out loans and buying a house. Even people with low credit were able to borrow money, and this is called subprime mortgages. Eventually, interest rates started rising in 2005 and 2006, which were signs of trouble. In 2006, home ownership had peaked and housing prices started to collapse. Keep this in mind for later. Now I'm going to turn it over to Graham.
Yes, and I'm going to start by backing up a little bit to talk about what banks did with these loans and mortgages. Banks would take these mortgages and loans and bundle them together with a bunch of similar mortgages. These were called MBSs, or mortgage-backed securities. There's different levels that you could buy based on risk, but Aiden will go over that later. So basically, they packaged these together and then sold them to investors and Wall Street banks on a secondary market. Because they could get money from selling these on a secondary market, they then had more money to loan out. So this is a continuous cycle of loaning out money, selling the debt, and then getting the money from the debt they just sold and loaning it back out to get more and more, because this would make them money. People love this because everywhere along the way, the people would take a cut. The banks take a cut, the people who were selling it, the secondary market would take a cut, and the investors would make a cut, because when people would pay their mortgages, then money would be sent through the banks right back to the investors. Now I want to talk about something that the SEC did in 2004. Something the SEC did in 2004 was relaxed the net capital requirements, or the money that the bank had to keep on hand, in some banks. Some notable ones were the Bear Stearns and Lehman Brothers, which, if we know, those were two of the biggest banks to fail. This freed them up so that they could invest 30 times or even 40 times more. Now back to the housing crisis. So basically, in 2006 and 2007, when the housing bubble popped and housing prices started to plummet because there's an oversupply of houses, many people defaulted on these mortgages. So what did that mean? Well, now the banks and investors, and lots of people had invested in these debt stocks or MBSs that were basically useless because there's no money being coming from the bank from the mortgages. So because of this, many banks basically had millions and billions of dollars invested in literally nothing. So now I'm going to turn it on to Aiden, and he's going to further elaborate.
All right. So essentially, what we want you to take away from this is banks screwed themselves over. Banks didn't even understand that they were causing their own demise. So now let me give you a little bit of background. Banks had standardly used mortgage bonds, which were bundles of AAA mortgages that were guaranteed by the U.S. government. So they were public, and the U.S. government had to insure them in order for the bank to be able to sell them. But by 2005, 2006, they had changed dramatically. These bonds were now private instead of public, and they weren't government insured. Now, these bonds were now called CDOs because they were synthetically changed. Okay? This is important because it essentially means that banks could fill them with whatever they wanted to. So they were not just filled with AAA mortgages, they were filled with AA, single A, B, double B, and even triple B mortgages. B to triple B mortgages are a lot riskier than A ones, and they fail sometimes. Because of what Graham mentioned earlier, the default rates on mortgages had risen. They had gone up from 1% to 8%. And once they hit 8%, that meant the B, double B, and triple B mortgages in these CDOs were worth nothing. So these mortgages that were being sold and told to people that they had value actually had no value. This caused a chain effect towards the AA tranches, which just means the AA parts of the mortgage. So the AA tranches were being recorded as 95% AAA rated, but in reality, they were only 25% AAA rated, and by 2008 they were 0%, which means the majority of the bond was worth nothing. Now I'm going to discuss some reforms that happened after the 2008 crisis. So the main reform was called the Dodd-Frank Wall Street Reform and Consumer Protection Act. This was the main source of relief for consumers after the fallout of the 2008 banking crisis. It was designed to prevent an event like the 2008 banking crisis from happening again. There are 16 components to the Dodd-Frank Act, stretching from corporate governance reform to insurance reform. The Dodd-Frank Act restricted the emergency authority by the Federal Reserve. Also, it allocated $1 billion to bridge loans, which helped unemployed homeowners cover their mortgage payments until they retain unemployment or reemployment. The act implemented a series of mortgage reforms as well. Now I'm going to turn it back to Graham, and he's going to discuss our solutions for the 2008 financial crisis.
Well, Aiden, I hate to break it to you. As for solutions for the 2008 financial crisis, we don't really have any that haven't been put in place. If you could take anything from what you've said before, the evil banks basically screwed themselves. There was really no outside factors that influenced the collapse, just poor bank decisions. The CDOs that they sold were worthless because they didn't realize what they were filling the mortgages with. The best explanation is fraud. Everything packed inside these CDOs are worthless, and banks just certified them and stamped them with a 95% AA rating so they could sell and make more money. The CDOs were private and not government insured, so the banks stuffed them with whatever they wanted. The only solution to make this to this is to make all mortgages public and must be government insured in order to sell.
All right, that will wrap it up. The 2008 financial crisis taught us to look for warning signs. Had we been aware of what was going on, we could have stopped the bleeding earlier, and many people would not have lost their jobs, and banks wouldn't have failed. This is why you should go and exercise your right to vote. Thank you for listening to our second episode of the series on bank failures. Make sure to listen to our upcoming episode on the recent Silicon Valley collapse. Thank you, and have a good day.